So the main reason that regulation exists is to correct market failures, right? So markets generally are really best positioned to allocate resources, right? Should we use trees, which are a natural resource? They can be used for paper, for furniture, for firewood, right? But what should we use it for? How do we decide that, and what ratios? Well, individuals and firms acting in the market, creating and reacting to price signals, will arrive at an efficient allocation of resources. Pretty common sense stuff. Sometimes, though, a market will fail to form. So we get no price signals, and we get no information to use, and so we don't get the right allocation. That's what economists will call a market failure. So we try to regulate only when we see a market failure. And this is something that we see, not something economists say, but it's something that we see sort of put forth, for example, in Bill Clinton's Executive Order 12866, which directs federal executive agencies on how to regulate. And this is a executive order that he basically amended from Ronald Reagan, and that George W. Bush re-ratified, and President Obama has also re-ratified. And here's what Executive Order 12866 says. It says, quote, federal agencies should promulgate only such regulations as are required by law, are necessary to interpret the law, or are made necessary by compelling public needs, such as material failures of private markets to protect or improve the health and safety of the public, the environment, or the well-being of the American people. So boiled down, what that means is, well, federal agencies, you need to regulate if Congress tells you to. You kind of have no choice. But aside from that, you want to regulate only when you see a market failure. And it also goes on to say, quote, each agency shall identify in writing the specific market failure, such as externalities, market power, or lack of information, or other specific problem that it intends to address. So market failure is really something you need to be able to identify before you decide to regulate. It's something that agencies need to do, and it's something that Congress as well, when it's directing agencies to regulate, hopefully they're finding a market failure that they can clearly identify and direct agencies to address. And the reason, quite simply, is that if we regulate when there is a market, and a market that's working fine to allocate resources, you're going to get unintended consequences. Okay, so externalities, as I mentioned, is one of the main types of market failure that we try to address with regulation. So what's an externality? Let me give you an example of something we call a negative externality, and that's pollution. And we regulate to try to abate pollution. So when you make goods in factories, let's say iPads, you're going to pollute, and pollution has a cost. However, when you, while you internalize, that is, you take into account the costs of the inputs that go into an iPad, for example, let's say steel, glass, chemicals that go into the batteries, you take account of those, the costs of those inputs. You don't take into account the cost of pollution, right? Pollution, you can think about it as a cost of creating an iPad, right? You pay for steel, you pay for glass, you pay for the chemicals, but you don't pay for the pollution. That's because the cost of pollution is imposed on everyone. And as a result, if you're not internalizing the cost of that pollution, we get more pollution than is efficient, right? Since there's no market for pollution, regulation is how we try to get the right amount of pollution. And what regulators do is that they try to take an educated guess at how much pollution is efficient, and then they require factories to pollute no more than that. And they can do this either through technological mandates, through setting standards, or perhaps by setting a cap and allowing tradable permits. So that's a negative externality. Then you've got, I'll give you another example of a positive externality, and that is provision of lighthouses. So lighthouses are very valuable things because they keep ships from running aground on shore. But if you build a lighthouse on a rocky shore, any passing ship will benefit from it, even if it didn't pay to build the lighthouse or to maintain it. So just like we all of us bear the costs of pollution, even though we may not be party to a transaction, we can all enjoy the benefits of a lighthouse, even if we don't pay for it. Right? There's no way, if you are a private entity, you build a lighthouse, you might get some benefit from that because you're probably building it because you own some ships. You're going to benefit from building the lighthouse. But every other ship that passes by is going to enjoy it, but you can't very well force them to close their eyes and not take advantage of the lighthouse. So you're creating more value than you can capture for yourself because you can't charge for them. as a result, since a producer can't internalize all of the benefits of the lighthouse, we get fewer than would be efficient. So how do we solve this? Well, you have direct government provision of the lighthouses, or you have it indirectly through subsidy. So now I'm going to get to the lesson that was all sort of set up. The lesson is this. Just because you see an externality or what looks like an externality does not mean that there is a market failure. So it turns out the lighthouses are actually have been provided privately for a long time. For hundreds of years, lighthouses had been used as an example of the classical market failure, the classical externality. And it wasn't until 1974 that Ronald Coase, who many of you may know that name, he is one of the 20th century's most preeminent economists, he's a Nobel laureate. He decided to look at the actual evidence of how lighthouses were built in England. And when lighthouses were first built in Britain, they were provided by private enterprise. How was that possible? Well, tolls were collected when ships reached port. So the companies that owned the harbor would also build a lighthouse. And usually, when you're going past a lighthouse, you're probably going on your way somewhere, probably to dock at a port, at a harbor. And so they were able to bundle these things together. So something that for 100 years at least had been thought of as being the paradigmatic example of an externality, the lighthouse, actually turns out that 3/4 of all lighthouses in Britain were provided privately. Let me give you another example. You have bees and pollination. So this is something that an economist named J.E. Mead in 1954 wrote an article sort of setting forth what he thought he had discovered, a positive externality that no market could ever solve. And it's very simple. Imagine a beekeeper who lives next to some apple orchards. And in the course of making honey, his bees provide a benefit, pollination, to the orchard owners next to him, right? So it's kind of like a reverse pollution. It's kind of pollution, but it's good. It's providing a positive externality to everybody around. The reason it's an externality is because he can't capture all the benefits that his bees produce. He keeps bees, he makes honey, so he can capture that benefit, but his bees are also allowing the orchards all around him that he doesn't own to exist. And the idea is that there can never be a market that solves this. How is it that a beekeeper is going to be able to go to the separate orchard owners around him and say, well, look, I need you to pay me because my bees are flying into your property and pollinating your apple orchards, and as a result, I'm getting a benefit because I need some of that pollen to make the honey, but actually you're benefiting more, so can you pay me the difference? It sounds impossible to happen. And so everybody thought for a long time that you could never see a market here. Well, and by the way, of course, what does this mean? If you can't see a market here, this result would be fewer bees and less honey than would be efficient, and so you have market failure. Mead in this paper said that because there couldn't be a market, the government should subsidize honey production. And in fact, if I'm not mistaken, I think we still to this day have a government honey subsidy program. So it wasn't until 1973 that Stephen Chung, who is an economist at Washington State, decided to study the actual apple orchards and beekeepers in Washington State. And what he found, when he went and looked at actual beekeepers and actual orchard owners, is that there was well-developed markets where beekeepers and apple growers regularly contracted for each other's services, right? They internalized the externalities that Mead had simply assumed would occur. So there was no market failure here. So even when you see an externality, what looks like an externality, there may not be a market failure. So you'd think that we would have learned this lesson by now, but I think that the proposed legislation that we're now seeing around cybersecurity actually shows us that we have not learned this lesson. So what is the rationale for cybersecurity legislation? It is that there is an undersupplied public good, right? That there's a positive externality. I think this is best captured by the report of the CSIS Commission on Cybersecurity for the 44th President. This was a document that was very influential in proposing cybersecurity legislation. And here's how they put it. They say, quote, "It is undeniable that an appropriate level of cybersecurity cannot be achieved without regulation, as market forces alone will never provide the level of security necessary to achieve national security objectives." So remember though, just because we spot an externality or potential externality does not mean that there is a market failure. So here's an example from cybersecurity. Say you've got, say you're the private owner of a nuclear power plant, and you are providing security for that power plant to prevent hackers from coming in, hacking into the power plant and blowing up the power plant. Not that that's possible, but that's sort of a separate discussion of how big the cyber threat is. So you're definitely providing some security, but of course in providing that security, you're providing a huge externality, right? By providing that security, you're not just protecting your investment, you're also protecting all of the surrounding population and certainly contributing to national security. And so the idea is that as a result, because you can't capture the benefits of all the security investment that you're making, you're not going to make a sufficient level of security investment. And so we're going to get less security and we're going to be less secure, and we need government to come in and tell the private providers how much security to have. And this is, just because you see an externality, what looks like an externality there, doesn't mean that there is one. So let me just give you an analog to that. I used to live up in Logan Circle, and the street that I lived on, these beautiful row houses, and they had out in front of the homes these beautiful, beautiful gardens, rose gardens and tulips, and just magnificent. And so when you think about that, those are externalities. And according to this theory, they shouldn't exist, right? Why is that? Well, you're a homeowner. You decide to have a garden out front. How much does that cost you? Well, let's say you go to Home Depot and you buy gardening supplies and you plant a garden. It costs you $100. Why do you do that? Well, it's probably because you're getting a benefit from that. You enjoy looking out your window and seeing the garden. You enjoy sort of having your neighbors think you have a nice garden. And how much is that worth you? Well, let's say you're getting $200 worth of enjoyment as a result. So $100 costs you to plant that garden. You're getting $200 worth of enjoyment. And so you're going to do it. You get $100 in surplus benefit to you. But of course, you're creating an externality. Everybody who walks up and down the street enjoys that garden, right? Everybody who, you can't stop them, you can't charge them, and so they're really going to get value from that as well. You're creating thousands and thousands of dollars worth of value as a result of you planting the garden. You can't capture that. So does that mean you don't do it? No, of course. We see gardens. We don't need governments to tell us to plant gardens. We see them, even though the private owners can't capture all the benefit. And with the power plants, it's the same thing. They provide security to cover, to prevent the cyber attack because they don't want to lose their investment. Sure, they're going to be positive externalities, but is the amount that they're providing for their own security enough to incentivize them to do it? And the answer is yes. All the evidence that, first of all, there's no evidence that we don't have an appropriate level of cybersecurity, and I can go into that later. Just to be clear, though, the optimal amount of cybersecurity is not zero, right? If you were trying to have zero cyber attacks, I can tell you two countries that have achieved that: North Korea and Cuba, right? They have unplugged from the internet, and so they don't have any cyber attacks. If you want to be attached to the internet, you are going to have some cyber attacks. It's just what's the right level, and there's no evidence that we don't have the right level right now. And there is evidence that private actors do provide cybersecurity, even if it's a public good, even if there is a positive externality. We see this in ISP security, for example. ISPs expend lots of resources fighting malware. All major ISPs have notification systems if customers have malware, and this raises their support costs. When they do this, they can't capture all of the benefits, or even most of the benefits. By doing this, they're creating a huge positive externality. And what's interesting is that they do this even though there is no liability for malware for ISPs. So even if it did this, it wouldn't be liable to anybody, even if the customer got some malware. And there's no government requirement that they do it, but ISPs still do this. The reason is they capture enough of the benefit to make it worthwhile, right? So even though you see an externality there, it's not a market failure. So keep that in mind when you're thinking about different policy issues. When you see an externality, ask yourselves, is there a market that's happening there already? Even though I see what looks like an externality, is there a market? And even if there is a positive externality, does a private entity already have an incentive to provide the right amount? Because if regulators, if that is the case, and regulators come in and choose a different level that they think is a correct one, it may not be, and it could be serious unintended consequences. Thank you. I think Henry's going to talk next.
That was for Jerry, not for me. Okay. Good afternoon. Thank you all for coming out today. I'm a law and economics professor. I spend a lot of time trying to translate economics so that lawyers can understand it. And I always start off my lectures by, not my lectures, my classes. In the beginning, there were markets and they were good. Don't laugh. Okay. Now, I've been corrected by one of my colleagues who says, Henry, you've got to straighten it out. In the beginning, there were property rights, which allowed markets to form, and they were good. Right? And this is, I only say this partly facetiously. In economics, we start off with a basic model of supply and demand. We assume that there are no externalities, there are no market failures, and so forth. And we find our equilibrium, our bliss point, as if we really know what we're doing. We draw these pretty graphs and make that work. And the first thing we show before we get to any market failures is to say, well, what happens if someone interferes with market prices and does not allow them to adjust? And if there's a price ceiling that is below what the market clearing price would be, so we had say we had price controls on gasoline, 1973, 1974, you end up with shortages, people waiting in line for gas, all types of things, right? So I like to characterize those types of constraints as like you get a balloon and you squeeze the balloon. Squeezing the balloon, we're not going to let the price adjust, but it pops out somewhere else. There's a reaction to it. People respond to changes in the market. They respond to changes in those incentives, and there are all kinds of stories, creative ways that people tried to get around those price controls in those days. So in the beginning, there were markets and they were good. If we interfere with the function of markets, we will get perverse, perhaps unexpected results. Sometimes markets fail. So we've talked about externalities, public good types of problems. There are other problems that we as economists identify. You could have monopoly is a commonly identified problem in markets. We have antitrust laws, for example, to try to deal with that. Information problems where we have asymmetric information. We generally think, for example, producers of products know a lot more about the characteristics of those products than consumers, and sometimes they can deceive consumers, so we have disclosure requirements dealing with that. Theoretically, that's the way we get to the market failure stuff. But we also need to recognize that there's government failure. That is, government policies often go awry and do not achieve their stated goals. And we can just talk about policy after policy, which has resulted in kind of perverse and unintended consequences. One of the things we were talking about earlier with someone before this is the CAFE standards, which are the corporate average fuel economy standards, which have resulted in many different changes in automobile designs, most of which lead to cars being lighter, which means that when cars run into trees, people are more likely to die. And so those regulations actually kill people on one part of the equation in terms of number of accidents. Now, there's a saying that comes along a lot of the time that says the law of unintended consequences. I want to raise that issue with you right now, and as people who oversee regulators, who write statutes that allow regulation to happen, if the consequences are foreseeable, then they're no longer unintended, okay? So you can't just kind of say, oh, we didn't know that was going to happen. If you get someone who comes up and testifies, hey, this is what's going to happen, and you still do it, and then you act surprised, you can't do that. All right. Now, I'm going to, so we've got government failure. I'm from George Mason University. One of our professors named Jim Buchanan won the Nobel Prize in 1986 for his work in public choice economics. The Washington Post congratulated him for a Nobel Prize in common sense. He was describing the way politics works, and everybody in Washington agreed that he was right. It's just the economists hadn't figured it out yet, so he got a Nobel Prize for describing that. Okay, So some basic rules, a basic rule for regulation, when you're thinking about rules, regulation, is to always keep in mind that incentives matter. Now, my topic today is healthcare, all right? And we can think about good government. Most people are here in Washington to do good things, to make the economy function better, to achieve justice, whatever your responses may be to that. However you want to define it, you've got in your mind some type of goal for why you're here, where you've got, I think, some probably public regarding purpose. That's a tough one sometimes when we get to a lot of public policy issues where there are going to be winners and losers, and how do you make those trade-offs. In cost-benefit analysis, the idea is that the benefit comes from solving some type of market failure, and the costs are the cost of complying with that. Well, when we get to healthcare, the problem with healthcare, with the healthcare market, is that we are regulating it, but it's not in the name of a market failure. It's in the name of an explicit, obvious government failure, which was the government price controls during World War II, when there was a lot of competition, for example, between civilian defense contractors to attract materials and human capital, workers, to their plants so that they could make a lot of money on their cost-plus contracts. The government was concerned about inflation in the economy, so as part of the emergency powers during the war, they placed wage and price controls on the entire economy. And beyond that, there were a lot more controls. For example, during World War II, there was a ban on the production of automobiles for civilian use. I mean, this was a serious threat to the survival of our country, and we're taking a lot of drastic steps. So one of the things that happens, though, is the employers, the contractors who want to make more money are not, and are running into shortages of workers because of the wage controls, tried to find other ways to compete. And one of the ways they ended up competing was by offering health insurance to their employees. Prior to that time, it had not been a standard part of the employment package, either in manufacturing jobs or any other type of jobs in our economy. But that was the way to attract workers to your job. You could compete on non-wage areas. Now, a key component of this was that after the war, the Internal Revenue Service issued a revenue ruling which said that those benefits being paid on behalf of the employees, the health insurance benefit, is a tax-deductible expense to the business, but is not taxable income to the employee. And that's the rule that we currently live under. We've never had a really big, serious public policy debate about that huge decision. But what that did was tie health insurance to the job, to the workplace. And we have spent years and years trying to counteract the perverse incentives that arise from that. So one of the things that the result of this is that, in effect, different tax treatments drives a wedge between how much insurance you want when it's paid for by the company and it's tax-free versus how much you would buy if you were spending your own after-tax dollars. So employees would tend to say, hey, anything you can call health care, let's put into this package. So things like eyeglasses, okay, your annual physical, all right, are things that are very predictable expenses. They're not risky things that we would normally buy insurance for, but because of the tax treatment, there's the incentive to put this into that package, all right? And normally insurance, things that people want to buy insurance for, are large ticket items, not routine types of items, all right? So instead, because of the tax treatment, people say, you know what, I would prefer to have lower deductibles instead of catastrophic care. I want lower deductibles. I want more coverage. And that distortion and that demand is created because basically we've got this, what's called the third-party payment system, where you never even have the incentive to negotiate with your doctor about the fees that you pay, because you don't pay much. You pay your $20, $40, whatever policy you happen to choose, but you don't even know how much the cost of a particular service is, because it doesn't make any difference to you. It doesn't guide which doctor you choose. Doctors don't advertise for price on services that are covered by insurance, so that we don't have the same amount of information we normally have in competitive market situations. Now this is a real fundamental problem to what we've got, because in effect we've taken the power of consumers out of the market, all right? And we as consumers, we're talking about our bodies here. You have an incentive to be well-informed consumers and to make cost-benefit trade-offs. How much are you willing to pay for health care? Well, right now, we pay so little on the margin, we want the best we can all have. But, you know, there are alternative courses of action that you may be willing to choose if you were paying for more of it. But right now, we're just not, most of us are not in that circumstance. But another thing that comes along that's kind of somewhat related to this is the role of state regulation. States have vary a lot in their approaches to health care, but most states have numerous mandates that they require to be included in every health insurance policy sold in that state. So I lived in California for a while. California mandates that chiropractic care be included in all health insurance plans. All right, so there are chiropractors all over the place in California. You know, at first I thought this was kind of you know, cool California thing. You go to the chiropractor. Well, it is. You go to the chiropractor to get a massage. Okay, but it's called therapeutic. All about shoulder stiff, you know, and you go in there and you pay $10 for a massage that would cost you $95 at a spa down the street. Hey, I mean, I did it. Was it illegal? No. Was it a moral hazard? Heck yeah. You know, I mean, I wasn't paying the full cost of what I was doing, but that's there. Now, these are not unpredictable expenses for most folks. You know, some people like to go in and get their back cracked, you know, but it varies from state to state. Who do you think in California was in favor and lobbied for this provision? Do you think all the people who wanted to have cheap massages were in Sacramento lobbying? No, it's the Chiropractors Association. And you see this from state to state where they fought about these things in these battles. So every profession, healthcare profession, has a lobbying shop in every state to lobby for mandates, to lobby to get them and to lobby to keep them. All right? And this has then resulted in more and more things being included in health insurance. Right? And so when we start talking about big questions about national health insurance, there's always the fundamental question of just exactly what does this include? You know? It's not exactly obvious where we should draw this line. But politicians in general want more. All right, so let's take these two things I've just talked about then. We take the price controls, which has led to the employer-based healthcare system. You add that in with the state mandates. Both of these things dramatically increase the demand for healthcare. You dramatically increase the demand for healthcare, what happens? Not a trick question. Price goes up, all right? And it continues to go up because people don't have the incentives to pay any attention to this stuff. So what are the solutions from this? I am not a Capitol Hill strategist, a legislative strategist, so, you know, I can say things that you know, maybe have no chance of ever happening. But the first and most obvious thing is to change the tax treatment. And there have been a number of presidential commissions that have done this, talked about this. Simpson-Bowles mentioned it, I believe, but certainly the Bush Healthcare Task Force suggested this. This is like, you know, asking yourself to get electrocuted because it's viewed as a massive tax increase, but it would dramatically change incentives and the structure of our system. Let me be clear. If we had not had the tax treatment beginning after World War II, our healthcare market would look entirely different. What it would look like, I don't know, but we just have not gone through that process to let that market evolve. And we've had dramatic improvements in healthcare. It would be great to see how it will work. Two, we can remove the mandates. Now, how do we do that? Do we want Congress going into all the states and telling them to do that? No. I think the best way to do that is to allow jurisdictional competition between states for insurance markets. So you say an insurance company could be chartered in Virginia and sell insurance, the Virginia-approved insurance policy nationwide to anyone, anywhere they want to, right? And as a result of that, you would find states competing on different things. My guess is they would compete on coming up with varieties of different health insurance packages that would look different ways. This would be very similar to the type of Delaware model we have in corporate chartering, where Delaware firms, if you're chartered in Delaware, you can operate anywhere in the country. Make that the same way with insurance. Break down the local monopolies in insurance regulation and have national competition for the insurance policies so that we can take advantage of competition. Right now, we have monopoly federal government, we have monopoly state governments. The federal government could do a great job by creating interstate competition in that competition. And finally, the bottom line is we need to empower patients. Patients need to have the incentive to shop around, to ask questions about payments and so forth. And how do we do that? I like health insurance, health savings accounts is one possible way. The proposal in Ryan's proposal for the The budget proposal includes some vouchers for Medicare recipients to shop around for different private insurance plans. That's part of patient involvement. That's shopping at the insurance policy level as opposed to at the actual insurance you buy. But once we open up, that's the nose under the camel's tent, in the sense that I could imagine some private Medicare alternative saying, look, what's going to be available to you is the opportunity to use some of this money to fund a health insurance, health savings account, to just buy a catastrophic care policy and use your own money for the lower expenses you have. All kinds of different ways to create with that. I'm out of time. Thank you very much.
All right, I'm going to focus on a couple of things that tie into what Jerry and Henry focused on. I'm going to talk about the SEC, the Securities Exchange Commission, because it gives you an example of a disclosure-based regulatory system. So we'll talk a little bit about information and how information flows, what incentives already exist for information to flow to investors and consumers, and how the government gets involved, and how these theories of externalities, market failures, and rent-seeking all sort of play in to this area. So the securities laws are at foundation, a disclosure-based system, rather than the prescriptive regulatory system envisioned by OSHA or by the Consumer Protection Safety Commission. It begins as a disclosure-based system. Just tell investors the value of what they're investing in. How much did we earn this year? What were our expenses? What are our assets and liabilities? And what cash was coming in and out? So in 1933, 1934, laws were passed to govern in this area. The disclosure system has evolved and it has grown, has grown like a weed into, not that I'm biased, but grown like a weed into other areas that make it more prescriptive and that move away from the disclosure-based system. So we'll talk about how that works. And then it also includes a prohibition on fraud, essentially, and a number of different iterations of prohibition on fraudulent activity enforced by the SEC, but that is also enforced by private litigation as well. So there are a number of complications that come from an SEC regulatory system that also is enforced not only by the SEC, but concurrently in private litigation as well. So first you got to ask yourself, what are the incentives that issuers might have to share information in the absence of a mandatory disclosure system? Would they want to share information? Well, one thing we can do is look historically, prior to 1933 and 1934. And what we saw at that time was a very vibrant, robust auditing profession. Auditors were coming in and certifying financial statements. We saw some pretty thick financial statements being given out to investors. Certainly not as complex as what we have today, but a system definitely did evolve to create financial statements, and an outside certification mechanism came in to certify the disclosures that companies were giving. So 1933, 1934, Congress essentially ratified that system, mandated that system, in a way that I think we can say causes some complications for how the system continues to evolve. The basic idea behind voluntary disclosure is that, look, issuers want to raise capital. That's the whole reason why they're in the financial markets. They want to raise capital. They want to get people to give them their money, essentially. So what are they going to do? Are they going to stay silent? Well, if they all stay silent, then investors are going to assume everything's pretty much average, right? But then immediately one of them will say, oh, wait, we'd like to share some information about the value of our company. And you'll see issuers start to compete for that fixed resource of investment capital. But then some investors will say, well, how do we know you're telling the truth? The next thing that evolves is intermediaries who are repeat players. Even though some of those players might come in and out of the markets and try to look for a sort of one-shot Ponzi scheme to make money, move out to the Caymans, and never be seen again, the repeat players, like auditors and other intermediaries, can have an incentive to keep an eye on what's going on and to come in and take a look at the books, kick the tires, and essentially rent out their reputational capital to the issuer. There are a number of other different mechanisms that can evolve to certify information that is given out to investors. Executive compensation, the issuance of stock to executives, and disclosure about how much stock you're issuing to executives, and we saw some of that prior to 1933 and 1934. The use of debt, the discipline of debt, the fact that bondholders probably monitor issuers more frequently than shareholders do, because shareholders are a little bit more widely dissipated. The bondholders, is particularly the initial bond issuers, the underwriters who carry the risk there, are essentially going to prepare for the possibility of bankruptcy, and in doing so, they're going to create all sorts of certification mechanisms to keep the company healthy, monitor the company's health. The indentures are going to have all sorts of things that require companies to keep a certain level of capital and to keep buffers in place to try to prevent bankruptcy. So the issuance of debt is one way to sort of to create mechanisms that actually spill over benefits onto the equity holders. Now, a couple of different arguments on the other side that I'll share with you. One is people will say, well, even though there are incentives to create information that will develop in the absence of a regulatory scheme, it will always under-incentivize information because there are some benefits that are essentially an externality, right? It's the standardization, the ability to compare. If company A gives voluntary information and company B gives voluntary information, there might not necessarily be enough because the provision of information by company A helps investors in company B because they have something to compare it to. And so the argument there is we need a mandatory regulatory system because of the lack of standardization. Now, I would counter that with an observation that there's one intermediary that developed to create essentially standardization of information, and that is the stock exchanges. The stock exchanges have an interest and can internalize this benefit because they list a number of, they list lots of companies, and they want to maintain high volume of trading because they get fees from that. The members of the exchanges get fees from that. And when, one of the things they also will do is compete with other exchanges. And so they want to maintain not only high volume and keep investors coming into the market generally, but they want to also have a good reputation at their exchange as well. Now, one of the problems that arises as the government regulates exchanges that we've seen again and again is that the government actually affirmatively requires exchanges now to do certain things, to require certain substantive mechanisms at companies, but also limits the freedom of exchanges and requires government approval of new exchange listing requirements. So where we initially saw the New York Stock Exchange, American Stock Exchange develop, NASDAQ develop as sort of spontaneous order, essentially. There were great examples of spontaneous order. They've now been completely co-opted by the government, and everything they do has to be approved by the government and is limited, essentially, by the government. And so, in some sense, I think we see regulation actually limiting the spontaneous order that develops to certify information. Another thing we have to consider is how mandatory disclosure systems interact with a private litigation system. One of the attributes of the securities litigation system is that it has an extremely high rate of settlement. I take that to be an indicator of a system that's broken. Essentially, we have 400 or 500 cases filed a year, and maybe one of them goes to trial. The rest, about half of them are settled, half of them dismissed on summary judgment or motion to dismiss. So 1 out of 500 goes to trial, maybe. The rest settled or dismissed. Now, what does that tell you about the quality of those cases that are dismissed? And what does that tell you about the incentives to settle, right? It doesn't seem logical that so many cases would settle unless you take into account all of the other incentives that a company might have to settle in advance of litigation. Proprietary concerns, concerns about the time of the opportunity cost of the time of the managers, concerns that during depositions, proprietary information might get revealed, and a number of other concerns that will that make securities litigation a tremendous business. So every time you have some SEC affirmative mandatory disclosure rule, you have to think about how that ties in to the securities litigation system. How it's a rule that will not only be enforced by the SEC, but will be enforced by a system with an extremely high rate of settlement as well. And now, another sort of dimension to this debate that goes to the evolution of the securities regulatory system from pure disclosure to substantive regulation is that it's begun to also impede on the state-based system of chartering competition that Henry mentioned earlier. So we have a system in which you can charter your corporation in any state in the country, and then you can that company can operate in any other state. And the relationship between the shareholders and the company is governed by the state of incorporation, by the rules of the state of incorporation, and litigated within the state of incorporation. So you essentially have competition between states to be a home for chartering. Now, proponents of the so-called race to the bottom theory will say that, well, what this means is that in order to get people to come incorporate in their state, states will race to the bottom to try to provide the least protections possible so that managers can get away with whatever they want. And those are the managers that'll, new managers will want that, so they'll incorporate in the state with the least protection. The race to the top theory says, no, it's quite the opposite, actually. No one would invest in such a company, in such a state, in such a lax state. Investors would always look for quality. And you could tell systematically if a state was doing a really bad job of regulating the relationship between shareholders and companies. Investors could see that. And so they wouldn't invest in companies incorporated in bad states, in bad actor states. So what do we see? What's the evidence? Well, about 50% of publicly traded companies are incorporated in Delaware. The rest, most of them incorporate in their home state. For those that incorporate in other states, there's a few that go to New York, Florida, Texas, California. But Delaware is by far the highest state of incorporation for out-of-state chartering. And there's about a 3 to 4% premium in IPOs if a company is incorporated in Delaware. So that at least indicates that shareholders think when they buy into an IPO that buying into a Delaware corporation, which is the dominant, the Google of state incorporation, basically, they think that it has quality. They at least perceive that. So that at least is some evidence that it's working fairly well. But some of the substantive items that states might regulate in the relationship between shareholders and companies are being preempted under Sarbanes-Oxley and then under Dodd-Frank by the SEC. And so some have argued that, well, this preemption kind of limits competition on the state level that might be a little bit more efficient, right? So where you come out kind of depends on which theory you buy more, but at least the IPO evidence indicates that to some extent this state-based system is working. Now, there are also self-regulatory organizations that have evolved. The exchanges are one example, but there are also a number of others, the National Futures Association, the Financial Accounting Standards Board, and the Financial Accounting Foundation. You know, to the extent that a self-regulatory organization becomes sort of captive of a regulator, I think it's not fair to really call it a self-regulatory organization anymore. It's more like an off-balance sheet entity of the regulator. But, you know, to varying degrees among those groups, some of them still maintain a lot of their independent character. National Futures Association, I think, is a great example. The benefit there is that they will internalize the costs of regulation. So, you know, the industry players who make up the self-regulatory organization might internalize the benefits because they help maintain the integrity of the industry. They might internalize the costs, certainly, because they represent companies that will pay for the costs of the regulation. And so you might find a better job of cost-benefit analysis because both sides of that equation hit the self-regulatory organization's members a lot more directly than a government agency would. There's been a push toward cost-benefit analysis at the independent regulatory agencies and also with the executive agencies. The executive agencies comply with OMB's directive on this, Executive Order 12866. and a subsequent order from President Obama. But there's been a push to also apply this to the independent agencies as well, and that's probably one of the hot debates in legislative oversight of the independent agencies. The SEC is subject to a rule that it do this. Not all of the financial regulators are subject to a statutory rule requiring them to engage in cost-benefit analysis. But I hope I've just sort of given you a little overview of some of the debates that you might see in an information-based, disclosure-based regulatory regime, and some of the debates that we'll see play out in the cost-benefit analysis that the agencies put out, and then judicial review of new rules, particularly under Dodd-Frank, that we'll see litigated in court. There was a big case last year where the SEC lost on this question, on the cost-benefit analysis of a rule. I don't think it's the last one. So let me close it out, hand it over to Robin. Yeah, thanks.